Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market analysis and earnings review. This video presents a direct informational narration of the source document.
Market overview and macro data. According to the source document, daytime trading across the four major indices on Wednesday, August 26th was entirely flat. However, after-hours trading saw significant volatility, driven by earnings reports from Nvidia and Salesforce alongside a finalized legal settlement from Meta.
Regarding the macroeconomic data, July's personal consumption expenditures, or PCE, met expectations closely. Core PCE month-over-month was flat at 0.2%, and year-over-year it held steady at 3.3%, both exactly matching forecasts. Headline PCE year-over-year came in slightly above expectations at 3.7% versus the anticipated 3.6%, while the month-over-month headline figure was 0.2% compared to a 0.1% estimate.
Following this data, two-year Treasury yields experienced a slight increase. The market currently assigns a 60% probability that the Federal Reserve will maintain current interest rates in September. Noticeably, the 10-year Treasury yield fell by 1.39% and the 30-year yield fell by 1.18%. The source attributes these sharp drops primarily to market signals regarding Treasury buybacks. U.S. second quarter real annualized GDP growth held firm at 1.5%, perfectly aligning with expectations. This stability was driven by steady consumer spending and solid exports, which offset a decrease in government spending during the quarter. Meta's state lawsuit settlement. Meta has finalized a settlement regarding a lawsuit brought by 29 U.S. states over child safety and data collection. Initial market fears projected potential penalties up to $1.4 trillion. Instead, the finalized settlement is capped at a maximum of $18 billion, with Meta continuing to formally deny the allegations.
The settlement breaks down into specific components. Operationally, Meta must restrict minor usage times and enforce nighttime bans. Financially, $12.7 billion, or 70%, is a guaranteed payment structured over 10 years. The remaining 30%, amounting to $5.3 billion, is conditional. This portion is only payable if competitors, specifically TikTok and YouTube, are subjected to identical usage restrictions.
Following the removal of this legal overhang, Meta's price action settled near positive 1% in after-hours trading. However, the source document notes that Meta's current valuation remains constrained, trapped in a channel between $581 and $632. This constraint is attributed to slower AI monetization relative to its tech peers. Monitoring whether Meta's AI investments can demonstrate profitability over the next 6 months remains a key focal point.
Salesforce earnings and AI. In the enterprise software sector, Salesforce released its second quarter earnings. The stock experienced significant after-hours volatility, initially surging up to 14% before stabilizing near a 12% gain.
The second quarter metrics were strong. Earnings per share reached $5.90, heavily exceeding the $3.27 estimate. Revenue came in at $11.35 billion, slightly above the $11.33 billion expectation. Gross margin remained relatively stable year-over-year at 77%, just under the 78% mark from the previous year.
Salesforce's historical revenue growth had been slowing from over 20% to approximately 10%. The source document highlights a shift driven by a new partnership with Anthropic, termed Cloudforce. This integrates Salesforce's CRM data into Claude chatbots using AI plugins. Notably, Salesforce is now generating nearly $4 billion in annual recurring revenue from its existing artificial intelligence and data products.
For its forward guidance, management raised expectations for fiscal year 27. EPS is projected between $16.67 and $16.71, with revenue estimated between $46.1 billion and $46.4 billion. The document notes that Salesforce's AI integration counters prior market narratives that AI automation would inherently replace high-margin enterprise software subscriptions. Based on these figures, forward valuation models estimate a January 2027 target between $332 and $498. On a technical basis, the post-earnings rally encountered a strong breakout resistance level at $277, indicating potential for a technical pullback prior to further upward movement. Nvidia's Q2 earnings breakdown. Nvidia's highly anticipated second quarter report demonstrated robust earnings. However, slightly weaker forward guidance on margins caused immediate after-hours volatility, with the stock initially dropping 3% before a subsequent rebound.
Nvidia's top-line figures exceeded expectations across multiple categories. Earnings per share came in at $2.22, beating the $2.09 estimate. Total revenue reached $96.22 billion against an expected $92.38 billion. Operating income was $63.96 billion, surpassing the $61.19 billion estimate, while gross margins landed exactly on target at 75%.
Analyzing segment revenues reveals significant outperformance in key areas. The data center segment generated $89.02 billion, and hyperscale generated $48.71 billion, both substantially beating Wall Street estimates. Compute network also overperformed at $88.3 billion. The AI cloud and enterprise segment was the only area to slightly miss, reporting $40.31 billion against a $41.96 billion expectation.
The source document outlines a critical systemic dynamic regarding this revenue. Nearly half of the hyperscale revenue relies heavily on circular financing. This indicates that funds utilized by massive hyperscale clients to purchase Nvidia chips often originate from cash or credit guarantees provided directly by Nvidia, creating a circular credit loop supporting current order flows.
Nvidia guidance and valuation. For Q3, Nvidia management projects revenue at $10.8 billion. The source document notes this outlook expressly assumes zero computing revenue originating from the data center market in China. The initial after-hours price dip was attributed to Q3 gross margin guidance. It is projected between 73.5% and 74.5%, slightly lower than the 75% estimate. The source document identifies rising memory storage pricing as a margin compression risk moving forward, a factor that persists even with Nvidia's planned product price hikes. Despite margin pressures, management issued an aggressive projection of 70% revenue growth for fiscal year 28, a significant increase from prior 40 to 50% expectations. This positive forward guidance, heavily fueled by increased usage commitments from Amazon, ultimately reversed the stock's after-hours decline.
Forward valuation models based on EPS projections indicate strong positioning. Applying a conservative 20 to 30 times multiple places fiscal year 27 estimates between $178 and $267, and fiscal year 28's between $251 and $377. A high-growth 30 to 40 times multiple places fiscal year 28 projections between $377 and $503, suggesting current price levels remain within safety margins through the 2028 fiscal year.
On a technical basis, initial support for Nvidia rests at $236. The long-term trajectory targets the $260 mark, with potential to push over $300 over an extended time frame. However, the source document emphasizes that the unexploded systemic risk of circular financing credit loops remains a critical variable for the long-term sustainability of AI hardware demand.